For most of human history, money was something you could hold, coins in your hand, notes in your wallet. If you owned it, it existed. If you spent it, it was gone. There was no confusion about what was real and what wasn't, but somewhere along the way, that certainty disappeared. Today, almost every dollar you use is in physical cash. It's credit, and most people never notice the switch. When you swipe a card, tap your phone, or check your bank balance, it feels like money moving. But what's actually moving in cash? It's promises, obligations, numbers updated in a database. And those numbers behave very differently than real money ever did. This change didn't happen overnight. There was no announcement, no vote, no moment where the public agreed to replace cash with credit. It happened quietly, step by step, until credit stopped being a tool and became the system itself. To understand how this happened, we need to rewind to a time when banks still revolved around cash. Deposits mattered, reserves mattered. If a bank didn't have enough money on hand, it couldn't lend much. Credit existed, but it was limited by something tangible. That constraint kept the system grounded. But as economies grew, that limitation became a problem. Governments wanted faster growth. Businesses wanted more investment. Consumers wanted homes, cars, and lifestyles they couldn't afford up front. Cash was too slow. Credit solved that problem. Instead of waiting for money to be saved before it could be spent, the system learned how to spend first and worrying about payment later. Loans expanded. Mortgages stretched longer. Credit cards normalized permanent balances. Slowly, borrowing stopped being exceptional and became routine. At first, credit was tied closely to deposits. Banks lent what they reasonably expected to have. But over time, that relationship weakened. Financial innovation made it easier to separate lending from actual cash. Securitization, wholesale funding markets, and interbank lending allowed banks to create credit far beyond their deposit base. Then came the turning point most people missed. Banks stopped lending deposits altogether. Instead, they began creating deposits as a result of lending. When you take out a loan today, the bank doesn't transfer existing money into your account. It creates a new balance. That balance didn't exist the moment before you signed the loan agreement. It comes into existence because you promise to pay it back. Credit doesn't move money, credit creates it. This is the moment cash lost control. Physical money became a tiny fraction of the system. In the United States, cash now makes up a small slice of total money. The rest exists only as bank-created credit. Checking accounts, savings accounts, and digital balances aren't piles of stored cash. They're claims on a system that runs on confidence, and confidence is everything. As long as people believe those balances can be used, spent, and transferred, the system holds, but that belief depends on constant borrowing. Because when loans are repaid, credit disappears, money is destroyed. If borrowing slows too much, the money supply shrinks. That's why modern economies are addicted to credit growth. Housing markets, stock markets, government budgets, all rely on expanding balance sheets. When credit grows, asset prices rise. When credit stalls, everything tightens. This shift also changed who benefits. Those closest to credit creation? Banks, governments, large corporations, and asset owners gain first access to newly created money. They spend before prices fully adjust. By the time wages catch up, costs have already risen. The result is a quiet transfer of purchasing power from savers to borrowers, from workers to asset holders. Inflation isn't just about prices going up. It's about who gets access to money first. Crises expose this reality. When confidence breaks, people don't demand credit, they demand cash. In 2008, the system froze because banks no longer trusted each other's promises. Credit vanished almost overnight. Governments stepped in, not to save cash, but to restore credit. Trillions were created to keep the machine running. The same pattern repeated during the pandemic. Economic activity stopped, credit threatened to contract. Central banks responded by flooding the system with liquidity, ensuring borrowing could continue. The priority wasn't stability, it was continuity. Because a system built on credit cannot afford pause, today, reserve requirements are gone. Cash constraints no longer define lending limits. What restrains banks now are regulatory ratios and risk models, many of them set far from public scrutiny. Credit expands not because money exists, but because rules allow it. This is why paying off debt doesn't feel liberating at a societal level. Individually, debt freedom is powerful. Systemically, mass debt reduction is dangerous. If everyone reduced borrowing at once, the economy would contract. Money would vanish, growth would reverse. So the system nudges behavior, easy loans, buy now pay later, long mortgages, minimum payments. Credit is encouraged because it must be. That doesn't mean collapse is inevitable. But it does mean misunderstanding the system is costly. Cash is stable, but limited. Credit is flexible, but fragile. One depends on reality, the other depends on belief. And belief can change faster than anyone expects. The real risk in that credit exists. It's that most people treat credit as cash, without recognizing the difference. They plan their lives around balances that only exist as long as the system keeps expanding. Understanding this doesn't require panic. It requires awareness, real wealth in a number on a screen. It's resilience, it's ownership, it's skills, assets, and optionality outside permanent debt cycles. Credit can accelerate progress, but dependence on it creates vulnerability. History shows this pattern clearly. When credit replaces cash, growth accelerates, inequality widens, stability weakens, and eventually, confidence is tested. The question ain't whether credit will disappear. It's whether you understand the system you're living inside. Because once you see that cash didn't vanish, it was replaced, you start making different decisions. And in a world built on credit, understanding that difference may be the most valuable asset you can have. If this changed how you think about money, subscribe. History doesn't just explain the past, it prepares you for what comes next.